Hello, and welcome to Peak Oil News for Friday, June 17th, 2022. Oil plunged today down to 110 at the close of the market. Most people attribute this to the Fed's aggressive rate hikes and strong signs of a looming recession. It could, of course, simply be a temporary mean reversion. Also, it looks like the White House is moving forward with the idea of placing some type of export cap on American oil. As I said yesterday, any kind of move in this direction is playing with fire. I'll link yesterday's video in the description so you can watch it and see why I believe this to be so. Please feel free to hit the like button and all that if you feel like you are getting value out of the show. All right, so today I wanted to focus on Libya. As I reported, Libya's oil production has come to a halt, and I wanted to take a quick look at how this could affect markets. Most people in the administration and the mainstream media, as well as some detractors in my comment section, believe that the invasion of Ukraine and the subsequent U.S. embargo on Russian oil are the main source of our pain at the pump. Clearly, there is some correlation in chronology if we look at this chart. So, it's not a foolish idea, but I do believe that there are deeper and broader systemic issues at play. But for the sake of a thought experiment, let's assume that the Russian embargo is the main factor at play. And let's look at how much oil has taken off, or rather was taken off of the market since the U.S. embargo started, according to Reuters. Here you see this graph is a little manipulative at first glance, but if you look closely at the numbers, Russian oil was just over 10.1 million barrels a day that they were putting on the global market. And now it is down to about 9.16, or rather it went down to 9.16 in April. Now, it's not on this chart, but interestingly enough, Russian oil production bounced back to 10.5 million barrels a day. So it went up. So in theory, it was just 1 or 2 months here that we saw any real declines of Russian oil hitting the market. It should also be noted that this oil is hitting the market in most places at a discount. So Russia was selling its oil at about 30% lower than the global standard, which would also, of course, be a downward force on the total price of oil. So we have about, just less than 1 million barrels a day taken off of the global marketplace. So now let's look at the prices of gas and oil and let's see what they did. So first we'll look at oil on the global market, and what we see here from the day before the invasion to last May is a price increase from $87 a barrel to about $117 a barrel. So some back of the napkin math here is stating that the loss of oil just in this little blip here led to a 34% increase in oil prices in just a few months. And let's look at the chart for gas. Here we see gas for average in February, the month that the war started. It happened late in February, so I think it's fair to begin at that month. Gas was just $3.51 for regular. And by the end of May, regular gas was $4.44. So that would be a 26% increase. This all happened to energy prices because of what appears to be really only 1 month of major disruption in Russian oil markets, or at least in their delivery. That led to just less than 1 million barrels per day being taken off the market. So now consider what will happen with Libya going offline, 1.1 million barrels a day. And this circumstance, because of its nature, is likely to last longer. There's no signs of it easing. I suppose we could expect gas prices to go up another 26% to, say, $6.25 a barrel. And oil prices, or rather $6.25 a gallon, and oil prices somewhere around $1.60 a barrel. And that is if Libya's issues are the only exasperating feature we see develop over the next month. Again, I want to reiterate this kind of logic only really works if you buy the line that the embargo of Russia is to blame for oil prices. But what I really wanted to show is how a small disruption can start having major impacts in the global marketplace, particularly after the globe has entered depletion. And I think the Libyan oil circumstance deserves more attention. Of course, the Libyan debacle has many of its roots in the Obama-Biden administration, so perhaps that's why there is only crickets about it at this point. Well, that's all I wanted to focus on today. Thanks for watching, and please let me know your thoughts on this subject in the comments. Oh, by the way, I want to make it clear, I'm not necessarily predicting at this point that gas is going to be at $6.25. I try not to make predictions specifically about the marketplace. I will make one prediction, though. There's this term, force majeure. If I were you, I would get used to hearing that term in the media, in the news, and probably even at the dinner table. I think it's going to be much more common over the next year or two. We'll talk more about it later. Thanks again for watching.